everybody. Thank you so much for being here today. I'm Samantha. I'm in Client Services here at the Retirement Group, and I moderate these weekly webinars. In just a moment, we're going to be joined by one of our senior advisors, Patrick Ray, who's going to be speaking to you, Raytheon employees, about some tax tactics that you could potentially use to boost your savings in retirement. Before I bring Patrick on, however, I'd like to just remind you, although we work very closely with both active and retired employees from Raytheon, we are not affiliated nor endorsed whatsoever by Raytheon here at the Retirement Group. We are a completely independent group of financial advisors. After Patrick's presentation, I will rejoin him very shortly for a quick question and answer session. If you think of any questions you'd like to ask him throughout his presentation, please feel free to use the Q&A box, and I will ask him as many as we can and answer as many as we can, time permitted. And with that all out of the way, I'd like to introduce you to our speaker, Patrick Ray. Hi, Patrick.
Good afternoon, everyone. Thank you, Sam. Hope everyone's having a great day, and we appreciate you joining us this afternoon. And today I'm going to talk about some of the things that should be considered as we're whittling away the end of the year miraculously. I can't believe how fast it's gone. And before you know it, it's going to be the end of the year. And the significance about the end of the year is there are some things for sure from a tax perspective that you would want to give some consideration to. And we like to think that from a planning perspective, we go over and above the general call of what our responsibilities are. And one of those is to help you from a tax efficiency manner in all aspects of your planning process. And so whether you're leading up to a position to ultimately retire or you're already in retirement, our responsibility goes way above and beyond just giving you investment advice as to what to do with your retirement assets. And it ties into some of these other ancillary things that get minute to the extent of how you can make the most of your tax efficiency from an income perspective, from an investment perspective, and from all things that we do in an effort to bring to the table. So we want to cover some of those things today, and that's what we're here to talk about this afternoon. So for those of you who have not heard of the Retirement Group before, and by the way, my name is Patrick Ray. I'm one of the senior advisors here with the firm, and our group has been working with Fortune 500 company employees for over 30 years, and we have a ton of experience in helping folks with respect to what their pension plans are doing and how they're formed and how they're calculated and how they apply to you, as well as your 401k options and healthcare benefits and all things that are relevant to what you would want from an advisory group or a partner when you're leaning into making one of the most important decisions from a financial perspective that you'll ever have to make. And so we take a lot of pride in that. And one of the things that you may find the most useful above the webinars that we do on a very regular basis, and Sam will drop some links into the chat to give you access to webinars we've recorded and all kinds of great data and information and relevant facts and things that you want to know when you're doing some homework for your own benefit and for your family's benefit. But the thing you might get the most value of is the complimentary financial analysis that we have, which is an effective stress test of your overall planning process to see if you're on track for the goals that you have set. And if you don't have any goals, we can help you develop some of those to make sure that you're in line to check the boxes to see if and when you need to retire or when might be the most advantageous date to consider retiring from all aspects of the planning process. And so that's what we're here to help you with. And I'll give you a way to get in touch with us at the end of the workshop in an effort to allow you to reach out to us in the event that you're open to doing that. If you're not following us on our LinkedIn page, I encourage you to do that. We have a update on a lot of levels at LinkedIn with respect to the new presentations that we have and all the data that comes out and anything that we have that's relevant to a specific scenario that you have that might apply to you. So we encourage you to scan this QR code and take a picture of that so you can follow us on our LinkedIn page in the event that you're not already doing so. So today we're going to talk about some of the things that I consider or we talk about as key questions or things that you want to be thinking about, right? Like, for example, what about the current year is different than previous years from a planning perspective, right? What kind of life events, if anything, have changed? Have you gotten married? Unfortunately, did you get divorced? Have you had children? Maybe you've had grandchildren. Maybe there's people that have come into or out of favor from a beneficiary perspective. For example, this happens frequently where if you don't have a spouse and you label your siblings as beneficiaries, maybe you lost a sibling, unfortunately, or maybe you have come out of one of those siblings have come out of favor with you and you don't want to include them in your planning process any longer. These are all things that you want to consider if you're not already doing so with respect to the big picture of the planning process for sure, because it gives you a more up-to-date version of what's best for you and your family specifically. And I can't tell you over the 25 years that I've been in the business to see how often things go unchanged because someone's not considering some of the things that I'm referring to. Like they got divorced 10 years ago and their ex wife is still on the beneficiary line for their 401k, for example. So make sure you consider that for sure as one of the couple of key questions that we talk about. Another thing to consider is if you have a perfect scenario from a planning perspective, you would have money equally in IRA funds, Roth IRA funds, and after-tax funds or individual retail accounts. And the reason is because then when you ultimately go to lean on these particular portions of monies to pull cash from an income perspective, you can manipulate to the best degree you can your tax situation. And so from a tax perspective, it's pretty simple on the IRA side. Whatever you remove obviously is income taxable to you, assuming that you're over the age of 59 and a half, then there's no penalties involved. If you remove money from a Roth IRA, obviously that is tax-free to you, assuming that in some cases you've checked the box that says you've held them for at least 5 years and you're over 59 and a half as well. But from an individual perspective, you might find that you have stocks in different accounts, or maybe you inherited some funds from your folks when they passed away, and it's just in an ordinary brokerage account. And so there are certainly some benefits to analyzing this pool of money for sure on an annual basis because of the potential capital gains, losses from sales, or tax harvesting that you could consider. And these things are all relevant to that particular portion of money. And in addition to that, there are also relevant facts related to your traditional IRAs and potentially converting some of those either from a traditional IRA and or a 401k into a Roth IRA. And so you would obtain tax-free growth once you got past the taxation part of what is required to do so. And so that should obviously be considered as one of the key questions that you ask yourself on an annual basis as well. And then maybe over and above the general thoughts of making sure that you and your spouse are well cared for and that your children potentially are in fine shape, assuming that they're going to be part of your planning process. Over and above that, are you charitably inclined? And if so, have you considered or done anything about the planning process of getting some or part of your funds or a lot of your funds, or in some cases, all of your funds, to a charitable organization of some front or of some sort? So these are all things that are certainly key questions that we talk to our folks about on a regular basis, and we want to make sure that you're doing just that and considering that. So we're going to talk a little bit about the Secure Act 2.0, which is an updated version. And so I'm going to cover some of the bullet points of that particular update, as well as we're going to talk about the tax brackets and specifically how this may apply to some of the considerations that you would want to give yourself or your family on an annual basis. And this might be one of the most relevant quotes that I've ever heard, which is, the art is not making the money, but it's in keeping what you make. So from that, it obviously correlates to a lot of concerns. And one of these is a most recent update on what they call the Secure Act of 2.0. And there's a ton of caveats to this particular Secure Act, some of which may not even apply to some of you or many of you in some cases. And so the reality is the biggest one was the RMD positions, where they allowed you to consider or have to start your RMDs, which are required minimum distributions from your IRAs. And those are mandatory to take, where the age in the past used to be 70 and a half. They had moved that to 72. And in December of this past year, they moved that to 73, with the expectation that if you don't turn 75 before 2033, the age is then 75. And so this just gives you a chance to defer monies that you would otherwise have to take from your IRAs and potentially pay tax on them. But as you can tell, part of the theme of what we have to talk about is there may be some reasons to consider potentially getting a conversion of some of those IRA funds into Roth monies so that it later reduces the amount of money that you're required to take from an RMD perspective. And so part of the Secure Act had a lot to do with other caveats that may or may not be relevant, such as reduction of RMD excise tax, the RMDs that aren't required from your Roth 401ks any longer, higher limits and looser restrictions on qualified charitable distributions from your IRAs. They raised the catch-up contributions, They've addressed the Roth version of matching contributions if you have a Roth option in your 401k. They give more exclusive options for part-time employees to protect and save themselves from retirement. If you're working into your 70s now, there's different stipulations on when you're required to pull your RMDs out, and if you can contribute to your retirement accounts that weren't as flexible as they are now. And maybe something that goes by the wayside if you happen to have children who ended up not using all of your 529 money that you had set aside for them, that you can move those monies into a Roth IRA for them. And so that's a pretty relevant topic for sure to talk about. So there's many aspects of this Secure Act of 2.0 that certainly are of relevant topics in some form or fashion. But from a tax perspective on the income brackets, some of you may not know that the income system, the tax brackets that we have, it's a tiered system, okay? And so depending on if you're single or if you're married with filing joint or head of household or separate returns would dictate what tax bracket your income is going to ultimately fall into. And you can see that, for example, on the single side, where the 10% bracket is up to $11,000, but then from $11,000 through $44,725, you would fall in the 12% bracket. And then from 44,725, you would fall into the 22% bracket all the way up to 95,375. And the significance of that is that these are some of the things that might go beyond general discussions to further look into in a given tax year so that you could potentially consider maximizing these tax brackets so that you pay some cheap and efficient tax at a reasonable time in your life, maybe even times that you can afford it because you're in a current income perspective because you have a job or you're still working, and basically parlay that into a scenario where you're getting the most from a life expectancy perspective on the taxes that you ultimately pay. And so on the capital gain side, there's an update on that with respect to 2023, where in some cases, depending on your income, you wouldn't even owe capital gains taxes on some of the after-tax funds that you may have if you're doing some tax loss harvesting or sales of assets that have gains in them. Of course, one of the general caveats to the planning perspective of those after-tax funds is remember the potential step up in cost basis that might be foregone if you're using those funds to live off of from an income perspective. And so there's a lot to that discussion that we'd have to pick up in a different topic or on a different day, but certainly some things to consider from tax and tax relationship perspectives. And so here we are a little past the mid-year point, going into the fourth quarter of 2023. And these are some of the topics that we think are relevant to for sure discuss. And so from a capital gains perspective, capital gains and tax loss harvesting are going to be relevant to that bucket of money that's in the after-tax funds. And so capital gains are found basically in your taxable accounts. And unlike your 401k or IRAs, that your taxes are due when the investments that you have inside them are sold. And specifically, in fact, if you have mutual funds within the framework of these after-tax accounts, some of the considerations that you would want to be concerned about or at least know about is that you'll have some tax responsibility to some of these funds, even if you don't take any money or sell any of the investments that are out there due to the turnover on the inside of the mutual fund themselves and the potential capital gains on the long-term and short-term side that they spin off. So if this is an issue, especially if you're still working, we may want to consider doing some tax loss harvesting to transition those assets into investments that don't do that. So, for example, individual securities or ETFs in some cases. And so I think that there's a lot to be said for this particular discussion if you have a larger portion of money in this after-tax bucket that we want to maintain, and we want to consider all aspects of the planning process and how it best suits you from a long-term perspective for sure. So on those fronts, speaking of terms, you got a short-term scenario where if you hold those for a short term, which is less than 1 year, you're going to owe capital gains rates on, or excuse me, ordinary income tax rates on those if you sell those assets. And then conversely, if you owe them for longer than 12 months, you would only owe capital gains rates, which we showed in just the previous slide, that if you are in a certain tax bracket, you could potentially owe no capital gains tax on those funds. And so the term tax loss harvesting is specifically for those. So if you've heard that term before and you're unsure of what that technically means to you, it's just a way to kind of do an x-ray, so to speak, on the investments that are in there and potentially getting away from assets that don't perform as you wish them to, or that it's time to move on for whatever reason from an investment perspective, or from a risk perspective, or from a tax perspective, or for any version of these things that may be relevant to you, that tax loss harvesting would be certainly a consideration for us to talk further about if you have money in one of those buckets. And from a review perspective, of course, we talk about reviewing this on a regular basis. And look, we're all busy, right? Retirement planning typically takes a backseat to many folks because of what comes at us on an everyday basis. And so it's best to address this stuff not just on an annual basis, but not to also wait until the end of the year. Now, specifically from my practices perspective, we do most of December using that day, that month, to do minimum distributions, beneficiary distributions, Roth conversions, and typical tax planning for our clients, so that we give them the best advice, but we don't let the end of the tax year go by so that you might miss an opportunity that would require you to do something within a given tax year because you thought maybe you could get by with doing it before April 15th of the following year. And so be careful about making this mistake where you postpone these decisions, or this review, for example, where you're not giving yourself enough time to create the actual function of selling some investments if you need to, or taking a distribution when you need to, or considering a conversion when you need to, all because your year-to-date income could be considered. And so, of course, the later in the year that you wait for this particular discussion, the more accurate your scenario will be, because you will have known what had come into the household from an income perspective if you do it in November, for example, or December, as opposed to saying let's do it in June or July, not knowing what the next 6 months holds in the given tax year. So certainly you might want to consider waiting for any planned withdrawals, for example, or conversions, and all of that kind of stuff, because the sizable conversion or sizable withdrawal that you may consider might actually put you in the next tax bracket. And so, as an example, this is what it looks like if you've got a married filing jointly couple with $100,000 of income. Their income is taxed at the 12% rate, and this is given based on the standard deductions. And if this person wanted to take a $40,000 withdrawal from their 401k, for example, because they wanted to buy a piece of property, or they wanted to pay some bills, or they wanted to help out a family member, or whatever, this would cause this person to move about almost $23,000 of money into the 22% bracket because of the tiered tax system. And so their effective tax rate on this scenario is close to 18%, because you got 12% given on the first $17,150, and then the rest of it falls in the 22% tax bracket of over 22,000. So something to consider for this person, as a prime example of what we would do as a review, is to say, hey, listen, we know you need the money, but if you spread this out between 2 different tax years, frankly, you could do this within 1 week if you wait until the last week of December to make a distribution of half the money you need, and then wait 1 week later and do the distribution on another week, which falls into the tax year of 2024, as an example. You would have $20,000 of this money at the 12% bracket, and then only 2,800 of it or so in the next highest bracket, for a marginal rate of 13.5% roughly, as opposed to 17.5%. So this is just one of many examples that we could run through with respect to what would be the most tax efficient thing for you to do. So it goes beyond just trying to maximize your investment returns and minimize your overall risk and maximize your ultimate income, but it also has to do with minimizing what you send to the IRS over your lifetime. And so sometimes that costs you some money in the short term to take advantage of what might be best for you and your family over the long term. Now, on the 401k contributions, things that you're doing while you're still working, another thing to consider as far as what goes on the list of things to contribute to on an annual basis, for sure. Obviously, you're participating in your 401ks. Hopefully you are. If you're not, absolutely stop what you're doing to do what you can to start contributing to your 401ks, especially if your employer obviously offers a match of some sort. But one of the questions you might want to ask yourself when you're doing an annual review, as an example, is, are you putting the distributions, or excuse me, are you putting your contributions into the right locations? So you have a pre-tax options. Some of you have a Roth 401k option. Some of you have after taxes options. And so depending on your household and your income situation and what you might consider to convert of outside IRAs to Roth IRAs and so forth, might help you dictate which one of these pools of money you should be participating in from a contribution perspective inside your 401k. Of course, that has to do with what your company is matching and how they match your funds, and if you're maximizing your contributions. And whatever you do, does it affect your 401k match from your company's perspective? And many of you don't know that, assuming that your plan allows this, and some plans do and some plans don't, but most plans are pretty flexible. And in giving that flexibility, it gives you a chance to save under 50-year-old folks up to 66,000 a year. And if you're over age 50, you can save up to 73,500 a year. I've had a few people able to do this because they have a spouse that's still working and they can live off of one of the salaries that were brought into the household. And it just gives them a way to catch up in case you fell behind because you put some kids through college, and maybe you suffered a relationship issue and you went through a divorce, and this cost you a significant amount of kickback on your ability to save for your future retirement. These are all things to consider, obviously, if in the event that you're trying to maximize things from a big picture or a broad perspective as to how to do it. And so the IRS gives you these limits, assuming that your plan allows you to do that. And so we get asked this question all the time: should you consider, or can you convert your IRAs to a Roth IRAs? Basically, what this means is that you're going to absorb some tax today to put your money in a position to grow tax-free going forward until the time that you may need them. And so it's going to increase your tax income today. It's also going to potentially affect your Social Security taxes that you pay if you're over the age of 62, or you are actually taking your Social Security income. It's also going to affect you potentially if you're over 65 and you consider your Medicare premiums, because your Medicare premiums have a 2-year look back as to how they calculate where your income is and what you're paying for your supplemental expenses. So there's a lot of considerations to think through as far as what you should do or what you should consider if you can or cannot participate or actually convert money to a Roth from an IRA. But as an example, we took that previous couple that had $100,000 of income. They have $100,000 of income and they fall into a situation where they're under the cap for the 12% married filing jointly tax filing. And that means that this couple could technically convert $17,000 of income, or excuse me, of IRA money, and have to report that as income and not put themselves in the next highest tax bracket. And so that allows them to take that portion of money and allow it to grow tax-free, assuming that they do both wait till 59 and a half or older and a 5-year window with respect to before they withdraw money from that account. And so it's a massive benefit to them. And, frankly, 17,000 doesn't sound like a lot of money, but let's look at an example if you wanted to do more. So you could do that with the same tiered thought process that if you wanted to do a larger conversion of, say, $50,000, this couple could do that, and the first $17,150 would fall in that 12% tiered bracket. And then the remaining $32,850 would fall into the 22% bracket. So it would increase your effective tax overall tax scenario today, but you look out 5, 10, 15 years or longer, and maybe that's the thing to do. And so often, and this came light to me, one of my very good clients, even though I've had this discussion with them on multiple occasions. I just spoke to them yesterday, and in fact, this very discussion came up because they're using some of their after-tax money that they have in the bank that had been gotten from a sale of a piece of lake property they had. And so because of this sale of property, they had money in the bank and they just thought, oh, well, it's accessible. I won't have to take any money out of my IRAs and pay taxes. Even though we've talked about this on a number of occasions and reviews, that it does make some sense to fill up these cheaper and lower income brackets with taxable income, because it allows you to pay some cheap tax on the money. And ultimately, as we all know, your IRAs and your qualified plan monies and your pension funds, these are tax time bombs in an effective world, right? So eventually, you're going to owe some tax on this bucket of money. And so the more you consider today as what is efficient, even 17,000 this year and 17,000 next year. I mean, if you do that 10 years in a row, that's $170,000 you removed from taxable scenarios and put them into a tax-free environment. So it may make a lot of sense to do that. So as a quick summary, be sure to review your tax situation on an annual basis, right? I know we're busy. Everyone is busy. Life comes at us very quickly. And so there's a lot of things to consider. And oftentimes retirement planning takes a back seat. But you need to do this on an annual basis for sure. So you need to consider strategy adjustments based on life events and things that I talked about earlier. If you had a life event of a child or a grandchild being born, if you went through a marriage or a divorce, or you lost a loved one because of a tragic scenario and they suffered an untimely death. All of these things should be considered with respect to how you set up your taxes and where you get your income from and what your beneficiary scenarios look like and all these things, right? Also, don't wait until April 15th because you might have lost some of the benefits because they needed to be done prior to December 31st of the previous tax year. So be careful about waiting until and putting this decision off until the following year on an April 15th kind of thought process. Confirm your contributions in your 401k and adjust them accordingly. And so, for example, have you raised your increase or increased your contributions to your 401k, even though you've gotten an increase in pay every year for the last 5 years? Well, some people don't know that you can actually do this automatically inside your 401k. Many 401ks have the option to just go in there and you check a box and it goes up by a certain percentage that you want each and every year. So you can raise it by 1 or 2 or 3 or 5% every single year, and you don't even need to do anything. It just happens automatically. So those are one of the things that I think takes a lot of anxiety out of future retirement planning because it just automatically happens and you get accustomed to dealing with the ramifications of what you get in your paycheck to spend to live as you wish or live your life as you want to. Also, which of the options make sense, right? The pre-tax, post-tax, or Roth options in the event that you have them. And then does it make some sense to pay some cheaper tax today? Like I said, that example that we talked about with a married couple with $100,000 of income, it makes some sense to convert some money for them, even though they might not even think about it because, they're in the 12% bracket. It's a cheap tax bracket and they don't want to take any money out of their IRAs or qualified plan funds in order to do that. So all things to consider for sure. And so if you haven't had a plan, it's normal because 74% of the people over the age of 50 do not have a written financial plan. And that's what allows me and all of my teammates to have a job. And so we encourage you, because it's free to do, to schedule some time with us. And we're delighted to help you in the event that you're looking for a partner in retirement. Okay. You can reach out to us at info@theretirementgroup.com. That's an email address. You can send us an email and we're delighted to answer as many questions as we can. Or connect with you. You can also call our 800 number, which is 800-900-5867. You can schedule time to visit with one of us if you take a picture of the QR code on the left, and it gives you access to our calendar where you can pick a time that's convenient for you, and we're happy to chat with you on that time frame. Or you can also take a picture of the link or the LinkedIn page that I shared with you earlier, which is where we have a lot of up-to-date and current information that could be relevant for you and your family. So we encourage you to do that as well. And with that, what I'll do is I'll turn the presentation back over to Sam to confirm if we have any questions before we let you go for the afternoon. Sam?
Hey, Patrick. Yes, in an effort to keep this short, we're just going to do a couple of the questions that we received.
Okay.
I did put a link into the chat. Feel free to book an appointment with Patrick after this webinar if you'd like to speak to him further about anything. Number one, Patrick, does it make sense to use my RMD to fund charitable donations if I don't need the money for living expenses?
Very good question. I suppose the answer is it depends technically, but as a real life example, one of my very best clients does this very thing. It was important to them to give money to their local church where they're an active member and participant in. And what they did was, what we do is we take their minimum distributions every year and we use that money to fund a life insurance policy that is designed to only pay a death benefit to the church, who's the primary beneficiary, pays the benefit to the church after both spouses are gone. And so that is referred to as a second to die policy. So this is one of many things that you could consider with respect to not just how to efficiently use your RMD monies that you may not otherwise need for income, as well as check the box that says I want to do something that's not only charitable, but important to myself and my family. That's a prime example of what you could absolutely do. So the answer to the question is yes, you could absolutely do that. Unfortunately, there's no way to get around the taxation part of it with respect to what you take out if you do that particular thing, where you're just going to pay some income tax on your minimum distribution and then use the balance of what's ever left. And you could put that in the scenario that I referred to as a second to die option to have a tax-free benefit given to whomever you wish. You could also use a donor advised fund in an effort to do that. You could also give that money, obviously, directly to a charity if you choose. So yeah, the answer is yes, you could do that, and there's other ways to consider doing something similar.
Thank you. Okay, last one, Patrick. How would gifting IRA assets to an heir affect my tax strategy?
Well, it gets the assets out of your name, right? So in other words, the reality is, if you want to do that, you're just losing control of that asset. And so many times folks are uncomfortable doing that because they don't know what life is going to give them to deal with, right, during their life expectancy. And so it is an option. But again, you could, and I think as we've talked about before, it's really important to remember from a tax perspective, we're not giving people tax advice, right? We're telling them things that are relevant to consider. And so we would obviously want you to consider your CPA or your tax professional before you did any of these things that we could consider might be best for you based on your circumstance or what we know about you. But from a giving perspective, you could obviously do that, right? There's also other ways to potentially include children and grandchildren and things of that nature in the event that you want to help them for other purposes that might be relevant to consider too. But the answer is yes, you can do
All righty, Patrick. That was it. Any
that. Okay.
other closing statements?
No, listen, we appreciate the time that you spent with us today. We hope you found some value in what we had to talk about. And there's obviously a ton of detail and specifics that are correlated to just your circumstance with what we talked about today in some capacity. And so, again, you can reach out to us at 800-900-5867. And you can also call or email us at the info@theretirementgroup.com. We're delighted to do what we can to help. And with that, we'll let you go. We hope you have a great day. Thanks for joining us.
Thank you, Patrick.